It's Financial Smarts Network. Now, here's Andrew.
Hey there, everyone. Welcome to Financial Smarts Network. We are back in the studio. It's tax season, and I'm here with my friend and CPA, Chris Piccurrio, and we are going to have some fun tonight discussing how you can help yourself with taxes, maybe get a little more, reduce your liability, however you want to view it. It's tax time. We've got a lot of fun and interesting things to discuss here in the studio tonight. So be sure you are here with us the entire segment here at FSN Talk.tv. Chris, welcome, man.
Well, thanks for having me, Andrew. I appreciate it.
It's always good. It's tax season, of course, so I appreciate you getting out of the office a little bit. Gives us something a little bit different to do than crunching numbers all day.
Exactly.
So, but yeah, no, I wanted to make this an enjoyable segment where we can teach our viewers maybe things that they haven't thought about if they're looking to file themselves, or even if we're using a professional preparer in gathering their documentations, things that they should be aware of. We're in the second year of new tax legislation, so of course there's plenty to discuss. And I wanted to kind of roll along with that and get your thoughts on, what do you, when clients are reaching out these days, what do you tell them as far as getting ready, documentation, things maybe they hadn't thought about, so that way they come prepared to our office and kind of reduces their cost and minimizes more of our time and effort, right, of the back and forth of you're missing this, you're doing this, so.
Right.
So what are you seeing lately as we get into year number two now, second season?
You mean we had changes to our tax code? Oh, gosh.
When did that happen?
Where have I been the last 2 years? Oh, man. All right. Well, I think I'm going to get a new career. But, obviously, tax reform, biggest change to our tax code since 1986, and provided taxpayers with a ton of opportunities. I think when we're talking about individual tax returns, there's been quite a large simplification in many areas. But there's still a lot of things taxpayers need to be aware of, regardless if they're using a professional or preparing it on a self-prepared platform, or scrolling down if the library still has forms and breaking out their typewriter.
Man, I haven't thought about the library or those. I mean, God, you're talking about old school. I mean, we've been around in the business, probably 25 years, both of us, give or take. And talking about old school, we started back with the old little Pentium computers, like pre-internet days, and time has certainly changed. But man, if someone's still doing it by hand, that's got to be rough. I couldn't do that these days with all just the complexity of things.
We'll run into a situation sometimes with a taxpayer who has a mature aged parent, and they've been doing it by hand, and it's kind of fun to see. But I'm not sure if libraries even still have the forms. I think no matter what your situation is, definitely you take advantage of some software, either some self-service.
Well, a lot of the stuff exactly online these days. You can free federal, state charges you nominal. So someone who can't afford professional help or maybe doesn't warrant it because they're it's not that complex in a sense, right? W-2, maybe a student loan interest, simple stuff like that. Yeah, I tell people all the time, you don't need us if your return's simple. But when it starts getting a little more complex, a lot of times the money's well worth it, right? And so especially couples who maybe had just gotten married in 2019. So we're filing season of 2019 right now. Filing season 2020, but for tax year 2019. So let's walk through, let's just say couples who are either married or newly married, married joint, married separate.
Right.
Because obviously that's a lot of people just assume, oh, we're married, now we got to file joint. But that's not always the best case scenario.
Exactly. Well, I always tell clients you can't put a price on love. So don't worry about getting married. Don't worry about the tax effects of getting married. But yeah, absolutely. So with tax reform, just walking it back a little bit, people have to understand, and this is a common question, that your marital status the last day of the year is your status for the entire year.
Yes.
So with that in mind, if you are married at the end of the year, then you can either file jointly or you can file separately. With tax reform, one of the things that has increased the tax refunds, or at least increased the amount of tax that's due for a couple, would be looking at filing separately. That might happen based on income. If the common occurrence would be is if you have someone that's a business owner or self-employed and they have a spouse that is a high W-2. First of all, congratulations on that. But in that case, it might make sense to file separately if you're doing if you're having a professional prepare your tax return. That's just part of the analysis we do on every return. And then and then we take a look at it. Now, if it's within $5 or something like that, it's not worth it.
Exactly. But we do the same thing as with our married couples, high income earners, even mid range. If we see something, then we're definitely kind of take that extra step and file it married, joint, married, separate. I mean, I had a situation with a couple of years ago, pre-tax reform, where a couple found me online and reached out, and they were in the process of kind of a divorce, but yet it's funny, right? Because even in divorce cases, they want a divorce. But the only thing they don't want is, to let Uncle Sam screw them in a sense, right? So
yeah, exactly.
Everyone cares about the pocketbook, even in a divorce situation.
You can't put a price on love or falling out of love, right?
But yeah, so it's, there's certain situations where, and that's the thing, a lot of folks do it themselves using online software, whatnot. But I always tell people you can't put a price tag on what we offer as professionals in a professional environment, because a lot of times we are able to spot things that the average person can't. Married joint, married separate, especially if you have children. Now with the new tax reform laws, we've got the new other dependent credit.
Correct.
And so there's that, which a lot of folks probably may not even still be aware of. I mean, a lot of people still don't know that the ACA penalty is gone, right? There's just so many changes that are come about.
So yeah, I guess back to the people getting married, what you're going to want to look at is there are a lot of things from the previous year tax return that can affect your current year tax return. So if someone's filing potentially together for the 2019 return, look at each spouse's 2018 return and make sure that you don't have deductions that you should be carrying forward onto 2019. Yeah. So a lot of times, I mean, in my practice, I'm seeing about 95% it's better to file jointly.
Of course.
But then again,
there's always the exception to the rule.
There's exceptions, and you know what? There are certain couples that actually like to keep their finances very separate, and whatever makes a happy home is a good thing. And we might file separately.
Exactly. And then speaking of filing separate, there's obviously other circumstances sometimes warrant it, even though it may not provide the best net tax effect for the household. Couples who perhaps, let's just say, maybe got married recently. One of the spouses has tax issues.
Yeah.
So there's other reasons, I mean, the minute you file joint and have a refund, Uncle Sam's going to keep that refund because one of the two spouses owes. I've had situations where it's, couples didn't know. They've come to me. They did it themselves. They thought it was rather simple. And then they're like, we lost our refund. So, it's just there's many different reasons, obviously, to address issues of married joint, married separate situations.
And here's another one where I've run into where I've had clients file separately and actually owed a little more money because one of the spouses is on a repayment plan with his or her student loan. And a lot of times those repayments are based on your income. And if you file jointly with your spouse, they're going to bring your spouse's income into that. They might still owe that student loan debt, but it's a cash flow issue, especially for a younger married couple that's maybe one's really a wage earner, one's still finishing up their school. They're trying to qualify for mortgage. They're trying to qualify to buy something, to have a vehicle.
Obviously, some assets.
We always say don't let the tax tail wag the dog, but we need to quantify that. Yeah. So I would say if for couples getting married, filing a tax return together. I mean, I don't know, get a glass of wine by the computer. It's kind of a date, right? Date night.
date night during tax season.
Yeah, it might end really bad or it might end really well. You don't know what's going to happen. But yeah, I would look at it both ways and really take if you need help, definitely get the help.
Of course.
That's one way to maximize your tax results. And one more thing, I feel like a misconception out there is that if you're married, you have to file jointly. You don't have to file. The only other thing is, I don't know about you in your practice, but guess what? Life gets sticky sometimes. Yeah. And there are times when someone could maybe still be married, but have a separation agreement where they're actually, for tax purposes, unmarried. Mm-hmm. So those are some of the things that we have to think about.
That, Chris, and the fact that we see it all the time in our practice. I do, I'm sure you do too, where couples will come to us. And I had an email the other day from a client. They're like, hey, Andrew, we still want to work with you again this year, but, we're no longer together. So we're in the process of a divorce, right?
Yes.
And you have to weigh all factors at that point in time of, what have they agreed to? What do they want to do? Sometimes it's the element of explaining to both, spouses of how this will impact them if they file joint, right? Because if they have a liability and they get divorced afterwards, Uncle Sam's still coming after both of them.
Exactly. If there's a liability, that's something that definitely complicates things, because what a lot of times you're going to find is that you're going to want to figure out kind of who has that share of the liability, and there's a practical side of tax return filing. So one other thing to consider, if someone's in the midst of a separation, a pending divorce, but they file jointly, that if they do have a tax refund, that doesn't have to necessarily be split 50-50. They could actually have two separate direct deposit bank accounts, which I would encourge, because if they get a check, then they're going to have to go to the bank together, and then they have to see each other again.
Yeah. And most of them don't want to see each other.
No, you don't want to see that. The only other thing I want to make clients or people aware of, I shouldn't say clients because this is such a broad brush we have, but if you are in a filing jointly, make sure that your spouse, especially if it's in a contentious situation, signs off electronically on the tax return filing. I can't tell you how many times I've had one spouse maybe come to us and say, I've never even seen one of my tax returns for the last 5-10 years. It's a sad situation.
That's tough.
Usually in a household, you have one of the spouses that handles the financial responsibilities, but each spouse should be aware of actually the tax filings and taking a look at those documents. So, yeah, that's always a lot of times we talk about deductions and credits, but filing status is the first thing you have to decide on a tax return anyway.
Now, let me transition over to another important one. Student loan debt obviously is getting to an astronomical level with kids coming out of school, graduating with debt. A lot of them, oftentimes not a lot, but students might have help from parents paying. So, and oftentimes I've seen it on returns that are self-prepared because they're simple. W-2, I just got a job, coming into the workforce, and I say, well, did you graduate with debt? Sure. Where's the student loan deduction? Well, my parents pay it, right? So they often miss that. So let's discuss that a little bit.
Right. Well, and with the student loan debt, a lot of times if you have someone that is, let's just throw the fact pattern out there, someone that just graduates from college, they're probably early 20s, their parents are probably in the prime earning period of their life, and most likely they might phase out of the student loan interest deduction. So what that means is that their income is too high to take advantage of the student loan interest. So that interest deduction is just going to go by the wayside. So it might be better for the student himself or herself to take that deduction.
Yeah, I mention it because obviously we see it as you do probably in our professional environment where we look at returns that come in as a new client and we look at it and it's like, you missed that, and then we are not privy to the parents' return, like you said, but it's just a situation where oftentimes a student can benefit, parents don't benefit, and it's just completely lost across the board. And sometimes it makes a couple $100 difference in a young person's return, and other times it might be more than that, depends on the interest.
Right, and something to consider for parents also is that if you miss a deduction, you still can amend your tax return for up to a few years. So if you feel like there's some gaps in your tax return and you've been preparing them, I would get with a professional and ask that person to at least do an initial talk, maybe a review of the tax return. The best case scenario is I've done some of these where I look at the tax return and I say, honestly, I'm not going to do any better than you can. Here, it's a simple, straightforward situation. Yeah. Take the money you'd pay for tax preparation, go on a nice weekend, go out for a nice dinner.
That's it.
Do something fun.
Yeah. And that's the thing is we take obviously pride in being honest with clients, right? And it's just not about the money. If it was about the money, certainly we'd be having some other career that makes us a whole lot more money.
We'd be dancing again, guys. Come on, you don't.
Something besides what we do, putting ourselves through brutal exhaustion and stress, of course. But overall, it's important. Because that's not how the entire industry works, not to generalize, but, there's just a lot of people out there who are just around just during tax season where we will both operate firms the entire year, of course, and help people with planning and all sorts of stuff. So, but, it's providing that honesty. And sometimes it boils down to telling someone, hey, you're going to get back $200 more. We're going to charge you $200 to do this amended return. It's really not worth it. Just keep your money and call it a day, right? So it's that kind of having the integrity in our business to be able to just be forthright and with people who come across to us for help. That oftentimes we can't help everyone because of the situation.
Absolutely.
So let's do this. We've got a lot more to discuss. We're going to take a quick break. Folks, stay tuned. Don't go anywhere. We'll be right back to discuss more, give you some tips and tricks on how to boost your refund, lower your liability, and we'll have a good segment coming up right after this break.
Hi, I'm Angelina with All Things in Order, organization designed for your life. Well, you can find me if you want to get organized, decluttered, you're moving, packing, whatever the case may be. You can find me on Instagram at angelina.atio, or you can call me at 404-431-2273, or you can go to my website at atio-organizer.com.
Hey, welcome back from commercial break. Chris and I are here in the studio as we were discussing everything about your tax return, how you might be impacted, what you should do if you're looking to file yourself, or even if you're going to use a paid tax professional, how to what to look at and what things you should do to make life easier for yourself and your tax preparer. So Chris, obviously with the tax law changes, one of the challenges we're seeing as professionals revolves around the 1095A health insurance subsidies and credits and whatnot. So the law obviously changed, and I'm still getting people like, hey, am I going to have the penalty? I didn't have insurance last year, and it's just always reminding people. Starting with 2019, that was one of the big, probably popular for a lot of folks in a lot of sense because they felt that we were being penalized for something a lot of people couldn't afford.
Correct. Yep.
So, but yeah, let's touch a little bit on obviously what people should be aware of. Even with the penalty gone, a lot of people still have insurance through the marketplace.
Right. So it's kind of rare that us practitioners or people in general feel bad for the IRS, but I actually feel bad for them because they were tasked with administering a health insurance subsidy program and a program in administering a penalty program for people that did not have qualified health insurance. So with the health insurance stuff, it's confusing. It's confusing for even us preparers. We're doing the best we can, and we want all the listeners to have the best result possible on their tax return. So as you said, starting in 2019, there is not a penalty for not having the appropriate insurance or
health insurance, yeah.
Exactly, health insurance. Now, that being said, there still is a reconciliation on a tax return for anyone that received a subsidy for their health insurance premium. And unfortunately, I don't know about you, but do you have a crystal ball?
Man, no, I don't. I wish I did.
Okay, because if I would then bet on who's going to win the Super Bowl next year. But the thing is...
your Titans came close, speaking of that.
I know. You had to bring it up, my poor Titans. But that's all right. We got next year.
But for those of you that don't know, Chris is coming in town from Nashville, where he's at, whereas he lives in his practices in Nashville. So he's obviously a local Titans fan. And I was watching that game, rooting for the Titans, man.
Well, thank you. And I went to actually the Titans Falcons game here.
Yeah.
And it was a great stadium, great environment, and luckily we won. But we don't have to talk about that.
We got a beat down, man.
We'll take it. We've had our plenty of beat downs. But so the reason is I don't have a crystal ball, and unfortunately, when you enroll in the marketplace, you have to estimate your income, and then that's what your subsidy is based on. And then your income is always going to be different. And
course.
that's the confusing part for taxpayers, that if their income is higher than they estimated, they're going to have to pay back all or a portion of that subsidy. And it could be a significant amount of money.
And you're right about that. And I think what's important for our viewers to understand, if they're not aware of, is just because the penalty's gone, starting with tax year 2019, if they do have insurance through the marketplace, they're still going to get that 1095A, and they still have to provide it to their preparer. Or if they're doing it themselves, it has to be on the return. They have to reconcile those credits, or else you're going to get a nasty gram from Uncle Sam from the IRS. Post-filing, probably rather quickly, and it's going to tell you that they're not processing. I mean, the ones we've been seeing is, hey, we can't process this return at all. It's not like, hey, we're missing this, please send it in. It's like, send this in within, 30 days or 20, whatever time limit they give you, because we're not processing anything. So if you're potentially due a refund back and you don't act, I mean, you're not getting a refund.
Exactly. And my biggest... we always talk about tax rates, and that's one of my pet peeves, like, what bracket am I in? Because it's really about your marginal tax rate that's important. And one thing for listeners or viewers to understand is that just because you get into a tax bracket, that doesn't mean all of your income's taxed at that rate. It's an increasing tax bracket, but we kind of talk about marginal tax rates and tax brackets. I'm not kidding you. I had a client in the 90% tax bracket, self-employed lady, that her subsidy payback was $18,000. If she reduced her income by $20,000, that subsidy payback went away. So again, not to get in the weeds too much, but when we talk about how do you boost your tax refund, be very aware that of your income. And if you are getting a subsidy and your income is increasing, then make sure you have some savings or increase your withholding with your employer to cover that, because it's an issue that's not going to go away, and you're going to have to reconcile it through your tax return.
Well, and it's important to know with that said, I mean, that's a great example, right, of, especially for self-employed people, which we got a different segment that you and I will cover with giving folks tips and information if they're self-employed, freelancers, gig workers. So we'll cover other stuff there. But it's important to note that planning is vital, right?
Right.
It's, during the year, you're limited to what you can do post-year, like in tax season. We get it all the time, like, hey, can we do anything? Well, it's March or it's April 14th.
Right.
So, there's limited to what we can do. But in that case, that in that client's example, I mean, if you're able to reduce the income by $20,000, look at that. You're saving $18,000 on subsidies. I mean, that's huge. So
it is.
And just, so look at the lack of planning potential that situation would cause, and people might often say, well, I don't make that or I don't have that issue. But yeah, you do. If you get subsidies and you don't realize it, a lot of times it's, that extra couple $1,000s, it's in this case 20, but oftentimes I've seen it to where the difference between getting your income down by $3,000 or $4,000 means whether you're repaying something or nothing.
Oh, with these subsidies, this is the funny thing is the highest marginal tax rate when you consider the subsidies are going to be incomes between $60,000 and $80,000, $90,000.
Yeah.
Your amount of income affects a lot of your credits, a lot of your subsidies, your paybacks, your child tax credits, your earned income credit potentially. So it's really that the biggest part of America that's affected by these credits. And like you said, I mean, there's not much we can do for 2019 still, but I'm going to encourage the viewers to start planning for 2020 right now. Your filing of your 2019 tax return is the first step in planning for 2020.
Yep, exactly.
If you don't plan, you plan to fail. I mean, and I stole that from my dad, a military background. So I'm going to give him credit. I doubt he's going to watch that. Well, he's got to watch it. So I'm going to bribe him.
You're the contributor on the show. You got to get him to watch.
And well, we did get him a non-flip phone, so he's doing pretty good.
Oh, there you
go. But the question is right now, what can we do for 2019 that really can affect your tax return? Walking it back, obviously, if you're getting some type of subsidy, you're going to want to get your adjusted gross income down quite a bit.
Correct.
One of the ways to do that is to contribute to traditional IRAs for yourself and your spouse if you're eligible. Contribute to a SEP or some type of retirement plan if you're self-employed. That can greatly
that could have
help.
A huge impact for someone who's self-employed, depending on the income and the structure of their self-employment. Absolutely.
Those are probably the two biggest things that you can change. If you're not getting the subsidy, I just want people to consider. Let's say you're W-2 people, you're lucky enough to have health insurance through your employer, you're a married couple. A lot of people are still in the 12% marginal tax bracket. Most of America is there. I'd encourage people to consider, even though it's not necessarily boosting your tax refund, is to contribute to a Roth IRA. You could still do that now for your 2019 tax return if you're eligible, and that money's going to grow tax-free.
Exactly.
And a lot of times clients want that immediate tax benefit.
That gratification, like, hey, and now and today, but yeah, sometimes, man, that's just not really the best long-term planning, the best long-term result.
Right. I can't look, and we're in a no-tax state, so I can't look at a younger taxpayer or any age taxpayer in the 12% marginal tax bracket and say, do a traditional IRA to save 12 cents on the dollar today instead of the
Put
Roth.
money away, exactly. Yeah.
But again, back to if they did the traditional, yeah, that might be a 12% marginal tax bracket, but they also a $6,000 contribution, just for instance, that could wipe out thousands of dollars of subsidy. So if you're not sure and you're filing your own tax return, maybe have someone take a look at it.
Yeah.
And really consider all your options before you click those buttons.
Absolutely. And then another one I think that is worth mentioning that folks should consider is contributing to HSAs if they have a health insurance plan that is high cost, high deductible, and it qualifies for that. I mean, that's another good way to sock some money away.
Absolutely.
And reduce your income, maybe your liability, and of course just put money away tax free in essence, right, and be able to use because medical costs are continually rising for all of us.
Exactly. The HSA or health savings account is a great tool because there are some people that are going to the IRA and the Roth IRAs are great tools. They should be part of your whole financial picture, but they are also restrictive on your distributions. Where the health savings accounts, you can make a contribution and use that distribution right away. There aren't as many income limitations to that. But obviously you have to have a qualified plan. So talk to your advisor or talk to yourself. I don't know, one of the two, maybe both. And but that's a great tool, and those maximums keep going up each year. They're indexed for inflation, and to have that money grow tax free, we're all going to have to deal with some health expenses in the future.
I had some just routine tests done recently, and got a bill in the mail for almost $900, and I was like, wasn't expecting it. But with the change in my health insurance plan that I didn't really not realize, I just didn't pay much attention to it.
Right.
Which I think a lot of us are kind of the same way. I got a $900 bill, called the insurance company, called the hospital, and they're like, yeah, you're responsible for it. So, yeah, it kind of is what it is. I'll pay it. But, it's just if we're not fortunate enough to have an HSA because of our plan doesn't qualify. But if we did, it'd be a great tool to be able to pull a distribution out and pay that money. So if folks can do that, it's certainly worthwhile to consider setting up and contributing to. Chris, one of the other things that I wanted to mention is, as we said, we're trying to provide folks some benefits as to what they should look at for this filing season for 2019 that we're working on right now. But it's also important to note, very important to note, that now is the time to start planning for 2020.
It starts now,
because you don't want to be having this conversation again next filing season, trying to say, oh, well, what should I do for 2020 and 2021?
Right.
So now is important. So one of the things that you and I obviously have discussed before, and we always look at with our clients, new clients, existing clients, is maybe Schedule A. A lot of people think that that's kind of gone away. It's still there. It's a little bit harder to get to those itemized levels where you exceed the standard deduction. But let's discuss a little bit about some, legal creative ways to how you can bunch them together, do things that you might be able to get a benefit from.
Right. Usually bunching is considered bad because it's part of your attire and it's just not a good look. But when it comes to deductions, bunching deductions can be a really good thing. So you're right. With tax reform, the standard deduction for married couples filing jointly is in excess of $24,000 now. So for a lot of taxpayers, they don't have over $24,000 worth of itemized deductions. Itemized deductions in general being your mortgage interest, property taxes, income taxes. Now there are some limitations on that, and we're going to let people hang on that because they got to watch more episodes, more shows, and charitable contributions. So there are certain things that you can do because as individual taxpayers, we pay tax and recognize deductions on a cash basis. That means when the money goes out. So if you're close to that $24,000 we'll go 24,000-ish threshold.
Or 12,000-ish for single taxpayers.
single.
A lot of single taxpayers, are able to meet that obviously much easier if they own a home and they donate and whatnot in state taxes. So it's 24-ish, this year because it's inflated
Right.
for indexed up for inflation, and 12-ish we'll call it for individuals. But yeah, there's ways you can do come at the end of the year and towards December.
Absolutely. So yeah, if you're and especially going back to planning. So if you're at that threshold where you're going to either itemize or take the standard deduction, you might want to bunch your deductions. So for instance, real estate taxes, especially if you're in a no tax state, because you're not hitting that. There's a $10,000 threshold for state and local income tax. Instead, pay your winter tax bill that's due in February before December. So every other year you're going to pay your summer tax bill, but every other year you're going to pay both winter tax bills. That's one option. Maybe if you have a charitable heart, bunching up your donations and your tithes into 1 year. And
what we're discussing as far as bunching folks is, if you contribute, if you are charitable and you donate to organizations, your church or whoever, other organizations, if you've got the funds available towards the end of the year, instead of say doing $3,000 this year like you might normally do and $3,000 next year, if you've got disposable income, just do $6,000 this year. It gets you over that threshold, and you might get a better benefit than doing $3,000 next year, being below the charitable the itemized deduction limit. And then you get no benefit, right?
Right.
So between that, paying your mortgage, your January mortgage payment in December, where the bank receives its and posts it in the current year, so you actually get 13 payments versus 12.
Absolutely.
In essence, every little bit helps. I always tell people it's not one thing that's going to make a big difference. Typically on your tax return, to reduce your liability or to boost your refund, however you want to view it. It's a combination a lot of times of a bunch of little things that make a difference.
Right, and I know, and just one more quick thing I want to throw out there is make sure you review your last year's tax return. There could be deductions carrying forward that you missed.
Yeah,
so.
Absolutely. Look, folks, we are just about out of time. It's been awesome, Chris, man. I appreciate you being
Thank
here
you.
in the studio, coming out during the middle of tax season. Stay tuned. For those of you that are self-employed, small business owners, we got another segment. Chris is going to be coming back in from Nashville in the coming weeks. We're going to do another segment and give you some tips and valuable advice that you can use for this tax season and to start planning for your 2020 tax year. So we wish you the very best and have a blessed evening. We will see you next week, same time here at fsntalk.tv. Talk to you soon.